discussing about maintenance of books of accounts in the last class. So let's move forward for that. So who need to maintain books of accounts as per the Income Tax Act? So if you are running a profession, if you are a doctor, lawyer, chartered accountant, engineer or any other professional, and you are doing your profession only, then if your receipt during the year, during the last 3 years is more than 1,50,000. So in any year from the last 3 years, your receipts are more than 1 lakh in books of accounts. Turnover is more than 10 lakh or your income is more than 1,20,000, then you need to maintain books of accounts. If you are an individual or HUF running business, then your turnover should be more than 25 lakh or income should be more than 2,50,000, and then you need to maintain books of accounts. So these are the limits that you need to follow, and you need to maintain books of accounts accordingly. What do you mean by books of accounts? Cash book, journal, ledger, sales bills more than 50 rupees, purchase and expenses original bills. So these things you need to keep as a books of accounts. If your professional receipts are more than 1.5 lakh, business turnover is more than 10 lakh or income more than 9.20 lakh. If you are an individual or HUF, your turnover should be more than 25 lakh or income should be more than 2,50,000. Then you need to maintain these books of accounts. Which accounting method you should adopt for books of accounts? So you can adopt any method, mercantile or cash, for accounting method or maintaining books of accounts. You cannot use mixed method, like some receipts for cash, some receipts for mercantile. What do you mean by mercantile? Accrual basis, as and when due basis. So due basis or receipt basis, mercantile or cash, whatever you call it, you need to maintain your books. Audit. Who are liable for audit? Whose audit are need to be done from chartered accountant? If you are running a profession and your receipts are more than 50 lakh, you need to get your accounts audited. If you are running a business and your turnover is more than 1 crore, then you need to get income tax audit. Your business cash receipts and expenses are up to 5% of total turnover, then you need to get audit only when your turnover exceeds 10 crore rupees. So if you are running a bank-based business, a business wherein all the receipts and expenses are through bank, maybe by UPI, by NEFT, RTGS, account pay check or whatever ways, then maximum 5% you do the cash expense and receipts, and your turnover limit would increase to 10 crore. The due date to getting the audit done is 30th September. Hope I'm clear on this part. Check. Page number 85. We are studying at page number 85. So this completes our business or profession head. Now we will. What is capital gain? Page number 85. Business or profession. Now we are starting the next topic, capital gain. So gain, as name suggests, gain on transfer of capital asset, profit on transfer of capital asset. What is capital asset? Land, building, machinery, shares, jewelry, archaeological collections, paintings, sculptures. These are capital asset. What is not capital asset? Rural agricultural land. So rural agricultural land is not a capital asset. Urban agricultural land is a capital asset. Stock in trade is not a capital asset. Personal effects like car, watch, or maybe your gold, uh, not gold, but any other thing which you keep as a personal things are your capital asset. Your personal laptop, anything. So whatever is your personal thing, it's not a capital asset, except jewelry. Jewelry is always a capital asset, even if it's your personal, because jewelry is always personal, but still it is not, it is a capital asset. Again, broadly, difference between sales and purchase is gain. What do you understand by profit? Difference between sale and purchase with some adjustment as permitted. So whatever, like for example, I purchased a land for 10 lakh rupees and I sold it for 12 lakh. So what is my gain? 2 lakh rupees with some adjustments as permitted. Now what are the adjustments? Adjustment number 1, cost inflation index and its use in calculating capital gains. So what are the cost inflation index? Only in case of long-term capital asset, not in short-term capital asset. So if it is a capital asset, it's a land which I'm keeping with me for a long term, like for more than 3 years. So some land is with me for 5 years. I purchased a land in 2018 and I'm selling it in 2023. It's a long-term capital asset because land is a capital asset. If it is kept with me for a long time, it's a long-term capital asset. Cost of acquisition should be adjusted for cost of inflation during the years of holding of asset. Now, for example, I purchased a land for 1 lakh in 2001, the base year. So this is a cost inflation index chart. Government has CBDT has notified cost inflation index every year. So this is the total cost inflation index chart till this year. So suppose I purchased one land for 1 lakh rupees in 2001. It would be equal to 100 rupees of cost inflation index. Now if I sell it today in 2023-24 or maybe today itself on 27th December 2023, now cost will not be 1 lakh rupees because I purchased it for 1 lakh, but the cost for calculating capital gain will be 3,48,000 because 100 rupees is equivalent to 348 rupees today. So 1 lakh rupees in 2001 is equivalent to 348 rupees now. So this is cost inflation index. Now if suppose I sold it for 5 lakh, so the cost is 1 lakh, sold it for 5 lakh. The profit is not 4 lakh. The profit is 1 lakh 52,000. 100 adjusted for cost inflation index. So it will be 348, that is 3,48,000. And then multiplied by whatever is the real price, which is 1 lakh. So it would be around 3,48,000. That would be cost. Now I sold it for 5 lakh, so I earned a profit of 1,52,000. Calculate indexed cost of acquisition. This is the formula which I have just used. That cost of acquisition divided by cost of inflation index multiplied by cost of inflation index for the year in which sold or transferred. 1 one more example I'll give you. You purchased the property in 2005-6 for 50 lakh and sold the same in 2020-21 at 1.50 crore. Next cost of acquisition, because it will be adjusted for cost of inflation. Cost of acquisition will be 50 lakh divided by 117. Now how this 117 has came? 56, it is 117. In 2020-21 it is 301. So 117 multiplied by 301. So 50 lakh divided by 117 multiplied by 301. It will be 1,28,063,028. 1 crore 28 lakh 63,248. So the long-term capital gain would be selling price minus indexed cost of buying. So that is 21 lakh 36,000. I hope this example is clear to everyone. What all deductions are allowed in capital gains? Absolutely, the cost of improvement. For example, an indexation also allowed on cost of improvement. For example, I purchased a house for 1 lakh in 2001, but in 2010, I got the second floor constructed on that house. So that is cost of improvement. I improved my house. I improved my house. If it is a general repair, it is not improvement, because house did not improve due to repair. It is just repaired. Suppose there were 3 rooms in the house. I got 3 more rooms constructed in the remaining house. Now it is an improvement. So cost of improvement will be added to the cost to the expenditure. This is allowed expenditure. I can deduct it from the sale consideration. Indexation also allowed. Suppose I did it in 2010, I can get the indexation from the cost inflation index. Expenditure on transfer. Suppose I sold the property for 10 lakh, but I paid some commission to the middleman for getting the property sold. That is an expenditure on transfer. I need to deduct that. Stamp duty, brokerage, registration charges, legal fees, these all will also be deducted, because this is what I have incurred during sale or during purchase of property. Long-term capital gain and short-term capital gain. Now I just told there are 2 types of properties, short-term and long-term. When something is sold after 3 years, it is long-term. Something is sold within less than 3 years, it is short-term. But there are some exceptions. So long-term is period of holding of asset is 36 months. Short-term period of holding is up to 36 months. Period will be 12 months for that purpose. That means if I hold asset for 12 months, it will be long-term. Listed securities, units of UTI, units of equity oriented mutual fund, zero coupon bonds. Period of holding would be 24 months in case of unlisted shares, immovable property. This will be the period of holding, and accordingly long-term and short-term will be decided. Now the question is, why this is decided differently? Everything is capital gain. Why we need short-term and long-term capital gain? On long-term capital gain, the tax rate is 20%. Short-term capital gain of listed equity shares, because short-term capital gain can be of many types. If it is on listed security, listed equity shares, it will be 15%. Short-term capital gain will be taxed at 15% if it is on listed equity shares. And short-term capital gain or other securities or other things, it will be as like normal income. Whatever slab rate is there, 2,50,000 till 250 zero. Above 2,50,000, it is 10%, 20%, 5%. Accordingly, it will be taxed. As good as normal income, normal tax. long-term capital gain on listed equity shares. So long-term capital gain on other things are 20%. On listed equity shares, it's 10% after 1 lakh per annum. So every year 1 lakh limit is given for long-term capital gain. More than that, 10% tax will be applied. Now capital gain of bonus share. As you know, what is bonus share? Whenever you are keeping shares with you for a long time, company gives you bonus shares on the main shares. Now bonus share is like a free share. You don't need to pay anyone for getting the bonus share. There is some voice issue. Okay. I hope it should be clear now. So on the bonus share, as you know, bonus share is free allotted to anyone. So naturally, sales value for that purpose, for capital gain on bonus shares, is actual. Cost of acquisition, purchase cost, would be nil because you did not purchase it. It is got allotted to you for the free. So it would be the cost would be zero. If the bonus is acquired before 1/4/2001, then you need to take fair market value as on 1st April 2001. How the capital gain of bonus shares will be calculated. Other sources. So what are the income covered in other sources? All incomes, everything is other source except salary, house property, business profession, capital gain. So whatever is not covered in any head of income is other source. If I just tell you in Hindi, जिसका कोई नहीं उसका भगवान नहीं, उसका other source होता है. So if you have no one for you, other source is there for you, because government will never leave you from taxation. If you are not able to classify your income under salary, house property, business or capital gain, classify under other source and it will be taxed there. What all incomes are covered? Every income other than salary, business profession, property and capital gain, all other incomes are other source. So I'll take some examples. What are other source income? Dividends. So dividend under section 1150 before 1/4/2020 on which CDT is paid is exempt. So all dividends are taxable, but before 31st March 2020, dividend was exempt. So if some dividend you received before 1/4/2020, it is exempt. All other dividends are taxable. Winning from lottery, races, you may earn something from bet with your friend, that is taxable under other source at the rate 30%. Now suppose you have to have a bet with your friend for 1000 rupees and you earned 1000 rupees out of that bet with your friend. Now you need to pay 300 rupees to government out of that. It is taxable at 30% flat rate, no basic exemption. No exemption of 2,50,000 is allowed. You need to pay complete 30% tax on winning from lottery, races, bet, and all these things. Interest on securities, interest on deposit, interest on loans, gifts. Gifts are taxable in other source. But I told in last few classes that gift from relatives are exempt from tax. Gift are exempt on special occasions like marriage, birthday, anniversary. Gift are exempt from other cases up to 50,000 in a year. Income from renting of furniture, machinery, plant, building, vacant land, these all renting income are taxable under other source. But repair, insurance, depreciation on furniture, machinery, plant, building, land are allowed as deduction, because only income will be taxed, not the receipt. You received 10,000 rupees in a month, but you did repair of 5,000, only 5,000 will be taxable because you have spent few money for that purpose. Now the next topic is assessment, which we will start tomorrow. So that's all for today. If there are any questions, you can ask on the chat box. Thank you.